Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Matt Zeigler is Managing Director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Sunpoint Investments.
Hey guys, this is Justin. In this episode of XS Returns, we bring in some reinforcements. Our good friend Matt Zeigler sits in for us and talks retirement planning with Wade Pfau. Wade is the founder of Retirement Researcher and the author of numerous books and academic papers on retirement planning. They discuss the 4% rule, variable withdrawal strategies, and Wade's safety-first approach to retirement. They also dig into Wade's work on retirement income styles and what it means for investors. As Matt mentions in the interview, there is probably no one who is more respected among practitioners who do retirement planning than Wade, and his unique insights shine through in this interview. As always, thank you for listening. Please enjoy this discussion with Wade Pfau.
Extra excited to be here. You're watching Excess Returns. I'm Matt Zeigler hosting today. Wade Pfau, thanks so much for coming on the show today. It's great to see you.
Absolutely. Thanks, Matt. Great to see you.
I have to say this, and this is as much for the viewers as anything else. Every firm, so working at an RIA, doing advanced financial planning and all sorts of investment strategies from the most basic to the most complicated, there's a handful of household names around a firm where when something comes to the table, when you hear a new idea, when you see a new idea and you go, I need to not just think through this at a high level, I need to make sure I kind of like check my sources, check my references, who's done the deep dive. And pretty much the two names that get thrown around the most are, did Michael Kitces write anything about this? Do we have something quirky about those dividend tax laws or whatever else? Or especially on the financial planning side, especially on the distribution side of financial planning, what's Wade Pfau said about this? Let me not underscore this enough for especially a lot of the more quant investing people who are watching this when it pops up on their feed. Like, Wade's your guy. If you don't know Wade's stuff, we're going to do a quick overview of a lot of things he's worked on. But Wade, I have to say this first, from the professionals out there, from the practitioners, thank you, man.
Oh, well, I appreciate the kind words. Yeah, thank you.
Well, let's dive into this first. I want to start with one of the big ones. We've covered this a lot on this podcast already. I mean, the 4% rule. It's been around for a minute. Why couldn't they have just made it the 40% rule? Let us take so much more money. It would have been so much better. So much more fun too. Can you walk us through, like, what is the 4% rule? Why do you care at all? And maybe what was the gateway into why you wanted to explore this further in your own career?
Okay. Yeah, I mean, sure. The 4% rule is actually now, it's the 30th anniversary this year. I think that October 1994 was the publication of Bill Dingen's famous article. And it was really meant to be a starting point for thinking about retirement income. And it was responding to what it fixed was this idea that folks like Dave Ramsey still talk about today, where if you say, well, the S&P 500 will give you 8% after inflation, so I'll plug an 8% return in a spreadsheet. Every year my portfolio grows 8%. I can take out 8%. I never even dip into my principal. Bill Bingen realized that was ridiculous. And he sought to just understand what is a more realistic type distribution rate if you want to keep that spending consistent over time. He looked at U.S. historical data going back to the 1920s and just assumed if you're planning for a 30-year retirement horizon, what is the highest percentage of that portfolio balance you could take in year one that then gives you a level of spending that you'll keep fixed, other than you'll adjust it for inflation every year, but you won't otherwise adjust it based on how your portfolio does. But you keep increasing that spending for inflation, and you want that money to last for 30 years. And usually it was higher than 4%. On average, it was closer to 6%. But he wanted to build in safety by looking at the worst case 30-year period in the U.S. historical data between the years of 1966 and 1995 and he called for using about 50 to 75% stocks in retirement. I usually stick to 50% stocks for examples, because I think 75% stocks is really pushing it for a lot of retirees in terms of being a lot more aggressive than we usually hear. But with a 50% stock allocation, you could have taken just slightly more than 4% in 1966, increased that for inflation, and then you would have run out right at the end of 1995, 30 years later. And that's where the 4% rule comes from. So it says, well, based on U.S. historical data, the worst case scenario was 4%. So if you're comfortable with that, that's what you use on a forward-looking basis to derive a sustainable spending rate from your investments in retirement.
It's really interesting to me too that because there's the practical reality of it. Like if you could jump in your DeLorean, go back in time, you and Bengen are hanging out, making fun of that Ramsey guy, and you're saying to each other, like, we want to set this in year one, because there's a really important, I think, psychological anchor that happens there at the onset of the distributions. How do you understand that now? You could take Wade Pfau's current day knowledge all the way back in time and say, is that a good way to think about it? Like that initial anchor of what you're spending?
But yeah, I mean, partly he was just fixing a real problem that was out there about, like I explained, with fixed rates of return. But on the other hand, he didn't necessarily take every step towards what is a realistic strategy. I think the basic idea, now we do have evidence that this isn't true, but people generally would like to have consistent inflation-adjusted spending over time. Like they should allow for their spending to grow with inflation. They want it to be consistent. And that's really what he was using as a starting point. Now, it's not realistic because most people won't. You're really playing a game with chicken in this scenario, whereas your portfolio is plummeting towards zero. You never cut your spending at all. Most people will do some sort of flexible spending strategy. And so if that could have been incorporated from the very beginning, it might have helped counteract some of the potential conversations there. But basically the issue is sequence of returns risk, that the order of market returns matters. If you get a downturn early on, even if the market recovers, if you're spending from your portfolio, you won't enjoy that full recovery. The Bill Bengen's 4% rule research demonstrated, it's really what showed the financial planning world what sequence of returns risk is. Kind of the unfortunate side effect was the specific assumptions he uses for the 4% rule create the most sequence risk. If you never adjust your spending in response to how your portfolio is performing, you have no way to manage that sort of volatility. And if you're willing to just make small cuts to spending after a market downturn, that reduces the likelihood that your portfolio gets into a death spiral towards zero, and it helps manage the sequence of returns risk. So in explaining what sequence of returns risk was, he inadvertently created a default strategy that maximizes sequence of returns risk. So maybe going back in time to talk to him, we get that sort of issue settled a little bit from the very start. Might have helped with a lot of the subsequent debate and discussions.
I can picture him as, Doc, not wanting to see the note that you're delivering to him. It's interesting too, because I actually really think that's fascinating. So number one, in a real financial planning conversation, nobody wants to hear about the doom spiral that you're serving up to them with their strategy. But you also wrote, and this was a real eye-opener to me, because you wed some of what we know from like the quantitative value investing world into this retirement income problem. You took the 4% rule and you said, wait, did this work in other parts of the world, geographically outside of the US? What did you find when you started to test this outside of America?
Right. And that was really my first study in financial planning. Earlier in my career, I was more of a traditional economist, and studying for the CFA exam. That's where I learned about the 4% rule. With other research I was doing, I had access to the global returns data set that's now available through Morningstar. It looks at 20 different, I think it's still 20 developed market countries going back to 1900. So I was just curious if Bill Bengen had been Italian instead of American, or whatever the case may be. Did the 4% rule work with other countries' financial market data? And instead of assuming US stocks and bonds, what if you use Canadian stocks and bonds or Portugal stocks and bonds? And this is still developed market countries, so it doesn't include, if you go back to 1900 and ask what are going to be the leading countries in the 20th century, maybe Argentina, Russia, China, different countries that ultimately had financial market collapses at some time in the 20th century and weren't even part of the data set. But with those 20 developed market countries, the 4% rule, it was really an artifact of US data. It also worked in Canadian data, but it really didn't work in any of the other data sets. And it's partly like if you lost a world war and experienced hyperinflation, Japan after World War II, Italy, Austria, Germany around World War I, sometimes World War II, you got very low withdrawal rate. But that's not the whole story. If you look at a country like Australia, it's actually the one country that had a higher average stock return than the US, and also less volatility. And really, great performing financial markets. But nonetheless, their 4% rule became 3% during the same sort of like late 60s, early 70s stagflation era. I think it's just sort of one of the characteristics of US data is we've had downturns, but markets usually recovered pretty quickly on a relative basis. Whenever we call the 2008 financial crisis, well, by the end of 2009, things are on the road to recovery. The 2020 spring with COVID, dramatic collapse that recovered quite quickly. And if it recovers quick enough, you don't really get locked into the sequence of returns risk because you're not taking that many distributions at a loss. And so the 4% rule survives in the US, but it really didn't work as well with other countries. And if you put all the international data together, the 4% rule worked only about 2/3 of the time historically, rather than like the 100% type number you'd get with just US historical data.
And would you put any weight on, because I know we'll touch on this, I'm sure it's somewhere, like would you put any weight on just starting conditions from the sense of how portfolio people think about this, like bond yields, equity market valuations? Would you put any weight on that, or would you reduce it all just down to, hey, sequence of returns is going to determine what you get out of this thing?
There's a lot of debate on that point. Now, bond yields, yes, definitely. I continue to this day to think the initial bond yield is incredibly important for laying a base of what bond returns would be. And then also, I just want to add a risk premium to whatever today's bond yields are to get an estimate around stock returns. I think that point's not so controversial. The market valuation side is more controversial. And that was something I looked at. Robert Shiller had that data in the 1990s about how well stock market cyclically adjusted price earnings explain the subsequent stock returns over the next 10 years. And in the historical data, it actually explains these sustainable withdrawal rate numbers really well. But about the time people started seeing those relationships, it seemed to have broken down somewhat because it's really, for most of the 21st century, would have been predicting pretty low distribution rates. So I don't necessarily make those adjustments for stock market valuations, but I do think the initial bond yield is very important, which really speaks to in the past with interest rates being so low. The big concern I had was that that's not translating into the 4% rule, obviously being safe. If you just had a 30-year TIPS ladder, you could have the 4% rule in the sense of 30 years of inflation adjusted spending. To make that work, you need a 1.3% real return. So in the recent past, the TIPS yields were negative. There was no 4% rule of bonds. Today, TIPS yields are in the 2% range. Makes it much easier to support something like 4% without taking any sort of market risk. And then if you want market risk on top of that, you have more upside potential, but you then also have the risk you might get an average return that falls below what the 30-year TIPS ladder could have supported.
Do you feel like, and again, I know we're going to dig a little bit more into this and some of the other frameworks you provided, but if all I gave you were the bond yields around the world and we ignored the equity side of it, we just built them from the fixed income ladders. Forgive me if you did this work and I haven't seen this work before. Has anybody showed like where the 4% rule does and doesn't work just exclusively based on bond yields around the world?
Where you're still going to assume a diversified portfolio, or you're only investing in bonds?
If I only invested in bonds.
I think the current yield curve will just tell you if you're going to have bond funds, you still have interest rate risk and you still have sequence of returns risk. And if interest rates go up, you'll have losses and then you dig a hole for the portfolio. So you could still have failure with a bond fund. But if you're simply building a bond ladder, the yield curve for each country would pretty precisely inform you about what the sustainable withdrawal rate would be over that time horizon. And if you hold those bonds to maturity, you don't realize any sort of interest rate risk. Any paper losses you might have had, well, they go away by maturity. So you could have a pretty good sense of what the yield curve in each country would support for 30 years of sustainable spending just by building a bond ladder around that.
I think it's really interesting, and I think it's really useful to work through, for planners to work through just the straight bond math of it all. So hearing you talk about something like that, it's a useful part of the exercise because it helps you, I think, just understand how that's the part that's straightforward and that's some of what you can expect. So then you have to be smarter than that. Let's get into some of the variable withdrawal strategies. You've done some amazing work around this. Maybe mention what some of the different approaches are once we start to get into variable withdrawal amounts. So I'm not just starting on that 4% initial assumption. I'm allowing some dynamic flexibility over time.
Okay, yeah. Let's like put two ends of the spectrum, and then everything else will fall somewhere in between. So one end of the spectrum, not variable. It's what we've been talking about already. How the 4% rule, I would just call a constant amount type strategy, or constant inflation adjusted spending, where there is no variation based on portfolio performance. Now, at the other extreme, you could call it a constant percentage or a variable withdrawal rate. If I took 4% of what's left each year, that's not what the 4% rule is, but if I simply said, okay, each year, January 1st, what's 4% of what's left in my portfolio? That's my spending for the year. That would be a constant percentage strategy. That's going to lead to quite variable spending. There's actually no sequence of returns risk with that strategy, surprisingly. So that's really the other extreme, where you could, if 4% is what you'd use with constant amounts, you might be able to get away with 8% variable rate, where you're not necessarily going to dip much below where 4% would have ever gotten you with the constant amounts. That'd be the other extreme. And then all the other variable spending strategies out there are some sort of compromise. The value of constant amounts is you have a pretty good sense of what your spending is going to be in the future. The value of constant percentage is you're going to fluctuate your spending to help manage sequence of returns risk and hopefully get a higher amount of average spending. So any sort of variable strategy beside that is how can we get some sort of balance where we're going to have some fluctuations for spending, but not too much fluctuations. And there's a lot of different strategies that are out there that usually different financial advisors have offered. One of my favorites is just where Bill Bengen, in one of his early articles, he talked about a floor and ceiling rule, where you use a constant percentage of what's left, but you have a hard dollar ceiling and a hard dollar floor that you won't go outside. So if I'm going to spend 5% of what's left every year, but if that number ends up being more than $80,000, or if that number ended up being less than $40,000, this is an example, I'll then stick to that ceiling or floor until the 5% of what's left gets me back somewhere in between. So I'd have fluctuating spending inside of a band. That can do a lot to help manage sequence of returns risk and still give you a good sense of what the dynamics are for spending. You can still have failure with that strategy because that hard floor that you build in ultimately could cause you to deplete your investments. But I think that's a good example. Probably the most famous variable decision rules are the ones developed by Jonathan Guyton and William Klinger. And they're complicated. There's like different variations of them. There's 4 possible different rules. But they're also looking at, they have a prosperity rule about basically when your current withdrawal rate is getting low because the portfolio is growing, let's kick your spending up 10%. They have a portfolio or capital preservation rule that, well, if it looks like your portfolio is losing and so the current distribution rate is getting too high, let's cut your spending by 10%. He's talked about inflation rules, which tell you when you are or are not allowed to take that inflation adjustment. And then also he has rules about when you're going to turn that off. If you're getting far enough into retirement, maybe you can stop with the potential cuts to spending. That sort of framework, it can be harder to implement at a household level, but it's probably the most famous set of decision rules out there. And there's others. I don't know if ratcheting rules, Michael Kitcey's developed those. The Vanguard talked about, it's kind of a floor and ceiling, but on percentage adjustments, which I think is a lot harder to think about than a floor and ceiling on dollar amounts.
How do you think about these? I feel like behaviorally, a lot of these they range from the way we feel, both as advisors and as people, just spending our money, to like the Surgeon General warnings of like, yeah, these cigarettes are going to kill you. Like, don't do this. There's a behavioral component of this, and we need some matching between the behavioral reality of what people are going to do and the actual math of what the consequences are. How do you feel about, like, as professionals, if you're guiding somebody in my seat to say, like, here's why you should be aware of all these rules, even if you're not going to use all of them all the time?
Well, I think ultimately partly the rules may just be a research simplification, because it also seems unlikely that anyone would follow any of these types of mechanical rules to a T. But I think where the advisor comes in, and ultimately you could think of it as another type of variable spending rule, but it's probably closer to what happens in practice, is I mean, the 4% rule idea is sort of set it and forget it. You choose the withdrawal amount in year one and then run with it. The reality is you have update meetings and you look at maybe a success rate with the financial planning software. And so this year, the success rate could be 94%. Great. Maybe you could spend a little more. Next year, though, we had a big market downturn and now it looks like the success rate is 79%. Okay, maybe we should make a cut to spending. So that sort of gradual adjustment based on how the plan is performing over time is probably a more practical way to implement a variable spending rule, but it's not necessarily one that is easy to run research-based illustrations of, especially because that would account for maybe in a particular year you ended up not needing to spend as much. Maybe in a different year you had an unexpected expense and so you had to pull out more than you were anticipating. And so that's more flexible type. Let's rerun the plan and see how things look and see if we should make adjustments. Can account for these sorts of real world needs as well in a manner that can be more effective over time.
And what about just the inside of that, the adaptations that our risk tolerance sometimes changes over time, or we have, whether it's a market-driven thing or a personal life-driven thing, a spouse passes away, or there's a change in lifestyle quality or whatever else. How do we think about how we update those inside of those variable withdrawal strategies? Any tips on that?
Well, yeah, those would be, especially the death of a spouse and that sort of thing has huge implications where it would speak to, okay, each year we update the plan with the new information. The death of the spouse can be a tricky one because partly you may not have to spend as much because like you don't need 2 meals at this point, 1 meal. So there's a lot of fixed expenses though. You still need 1 refrigerator, 1 house and so forth. But then like taxes can go up. There's the widow's penalty. You lose some of the Social Security benefits. You may lose a pension. So you really have to reevaluate things at that time. And I think that speaks just more generally to the value of working with a financial advisor who can help you do these sorts of updates to the planning and to make sure you're still on a sustainable trajectory and to make adjustments where needed, incorporating any of these types of outside considerations as part of that process. It's really becomes things you can't just do research about. Like you can model what happens if one spouse dies at age 70 or age 80 or age 90, but it's still, until you know what actually happens, you gotta wait to make those types of adjustments. I think it's hard for the researcher to model. It really needs the flexibility of that real world planning experience.
I think that's a perfect segue to get into one of my favorite things you've written a lot about, which is this idea of safety first retirement planning. You want to just define what that is, what that means, then let's unpack some of the layers?
Mm-hmm. Sure. And this is, so originally I talked about 2 different schools of thought to retirement planning. I think later we may talk about retirement income styles where I've made a little bit of a modification to that. But the basic idea of safety first retirement planning, it's really the other end of the 4% rule is implicitly probability based retirement planning. I'm going to spend from a diversified investment portfolio and that will probably work with maybe a high probability of success. If you're safety first, you're not necessarily comfortable basing your retirement success on something that will probably work. You'd rather have some sort of protection, at least behind the assets for your basic spending in retirement. And so you can develop contractual protections by holding bonds to maturity, Social Security, traditional company pensions. And then that's where a conversation around commercial annuities may be relevant. If you're safety first, you really want to look at what's my essential spending in retirement? How much reliable income do I already have? Let's just make a simple example. I have $60,000 of essentials that I want to make sure I can cover with Social Security. I'm just making up numbers here, but Social Security will bring in $40,000. There's a $20,000 gap there between what I get through Social Security and what I'd like to have covered. How do I fill that gap? If I'm more probability based, I'm not really focused on filling that gap for essential spending. I'm fine just taking that from the investment portfolio as part of my overall lifestyle distributions. If I'm safety first, I'd really like to fill in some sort of reliable income for that gap. If I have more of a time segmentation style, I might do that with a bond ladder. If I have more of a what I call income protection or risk wrap style, that's where I may look to an annuity with lifetime income protections to make sure I have enough reliable income to fill that gap and have that full $60,000 that I've decided really is necessary to meet my essentials on an ongoing basis in retirement.
I think this piece it's easy to talk about. It's hard to have the conversations and actually pin down with people. But that idea of just mapping essentials, it feels like that's actually more than half the battle here, and understanding what this is.
And there's some conflict there where I think some people, it's hard to define essentials. They have a lifestyle spending goal in mind. And if you ask them, well, how much could you cut that and still feel comfortable? Nothing. And if they really can't cut any of it, then maybe their overall lifestyle goal is their essential spending. But if you're safety first, you are more willing to think about this spending is more core to an essential retirement. That spending, I'd be okay making some cuts there. Don't have to go to the fancy restaurants as frequently, that sort of thing that's more discretionary. And if you can think that way and say, okay, here's essential spending, here's discretionary spending, that would be part of resonating more with a safety first approach where you'd want to then make sure that essential spending is protected.
So if we have an honest conversation about essentials and we understand what those are, I do want to talk about the dirty word a little bit. I want to talk about just like what an annuity is in the sense of asset liability matching, because I think asset liability matching in terms of covering essentials, especially from the safety first framework, is really important. Let's just start there. If I know my essentials, how do I asset liability match that? Why is an annuity potentially a good way to solve that problem?
Yeah, and that asset liability matching point, that's really important because that's why retirement income is different. Pre-retirement, we usually think more assets only. We're just trying to seek the highest risk-adjusted returns on our portfolio to grow that pot of assets. Post-retirement, the reason you're growing those assets is to fund liabilities. And that's where that asset liability matching, you want to match up risk characteristics. So for my essential spending, that income gap I was talking about, the assets you're going to earmark to cover that gap, you want to match risk characteristics. And if you view that as essential spending, you can't take risk with essential spending. So you want some sort of contractual protection. That's where the annuity can enter the conversation as a tool that provides a contractually protected lifetime income that for anyone living beyond life expectancy would perform better than a bond portfolio because you get that additional risk pooling through insurance that can support more spending than bonds. And that ultimately, of course, you could also try to use the diversified portfolio to get the risk premium from the stock market to support more spending than bonds. But risk pooling through insurance really is competitive with the risk premium from the stock market. So people have options and they're not necessarily sacrificing anything on the upside if they allocate a portion of their assets to an annuity to provide a protected lifetime income stream to make sure those income gaps for their basic expenses are covered.
Talk just for a second about it, because I think this gets danced over, not in defense of annuities exactly, but in just defense of the concept. Talk about risk pooling, for example. Just explain what that means. Explain why this is so important and why there's worthwhile conversations here because of just that thing existing.
Yeah. So let's just say my life expectancy is 85. That means there's a 50% chance I'll live beyond 85. 50% chance I won't make it to 85. But I can't, if I'm going to self-manage my longevity risk, I can't just assume I'll live to 85 because there's still 50% chance I'll outlive my plan. So then I have to get into, well, do I plan to 90? Do I plan to 95? Do I plan to 100? The more worried I am about outliving my money, the higher the planning age I need to use. And if I just think about building a bond ladder as a starting point, the less I can spend because I have to stretch that out for longer. Same with any sort of investment approach. The longer the time horizon, the lower the sustainable withdrawal rate. Now, so that's, if I self-manage longevity risk, I'm either alive or I'm not. If I'm worried I might live to 100, I have to assume I'm alive to 100. That's going to be expensive to fund through 100. Where it's different for the insurance company is they have a large pool of customers. Some will live a long time. Some won't live very long. But everyone enters that risk pool, and that allows the insurance company to account for the survival probabilities. So they can pay everyone in the risk pool like they'll live to 85, because those who don't live to 85, part of their premiums subsidize the payments to those who live to 100. And that can, like if only 10% of their customers are expected to live to 100, they only have to set aside 10% of the present value of what's needed to fund that age 100 spending. Whereas me, on my own, I'd have to set aside 100% of the present value of what I need to fund that age 100 spending. So I can meet a spending goal more cheaply as a consumer through an annuity than I can through building my own structured like bond portfolio to do that, because the insurance company has that ability to pool that risk. That means for a given amount of assets, the annuity can fund a higher level of spending than bonds. Well, can it fund a higher level of spending than a diversified portfolio? That's where you have to introduce, the stock market. So there's a risk premium. You may get a better performance through the investments. But then when I compare the two, it's not obvious that the investments are going to beat that risk pooling provided through the annuity. And of course, you could also say, well, those who don't live as long, they got a raw deal out of the annuity because some of their premiums just get diverted to those. Now, it's wrong to think they get diverted to the insurance company. That's not true. They get diverted to those in the risk pool that live a long time. But if you don't know which group you're going to fall into, the annuity can allow everyone in that risk pool to enjoy a higher standard of living while they're alive. And because the longer you live, the more money you need to fund your retirement, the more money you get out of the annuity. And if you ended up not living as long, if I only make it to 70, but I was basing my plan on the idea I might live to 100, I had a very frugal retirement. Whereas with the annuity, I could spend as though I was going to make it to 85. And so I could have a much higher standard of living for those retirement years. And that's where the annuity really can enter into that conversation as a way to boost spending relative to bonds for retirees. Now, not necessarily relative to stocks, but it's competitive there, and dig into the research. It's a competitive source of spending to what the risk premium from the stock market. Like with stocks, you expect to spend more than bonds. With the annuity, you can spend more than bonds. And they're kind of comparable to each other about how much more you can spend than bonds.
Depending on your lifestyle, depending on your lifetime, depending on all these things.
And depending on how worried you are about outliving your money. Because the more worried you are about that, the less you're going to spend trying to self-manage that with an investment portfolio.
It's interesting because it says to basically take the probability based investment side of it, and especially for a piece of your essential expenses, how do you think about what those essential expenses all add up to over some expected time horizon? And does it make sense to take that probability-based decision and outsource that to a company who's going to do that across a risk pool of people, not just me alone with my sequence of return risk? Is that a fair way to characterize it?
Right. And yeah, and if assets aren't volatile, they don't have sequence risk. And the insurance company is doing the asset liability matching. They have life insurance policies. They have annuity policies. They have a pretty good idea about how much they're going to have to spend each year to pay policyholders on both the life insurance and annuity side. And so they can really build that diversified, longer maturity, credit risk type fixed income portfolio to manage that liability. And therefore, their internal bond portfolio will tend to be able to earn more than a household could build if they're just putting together a bond portfolio on their own at a household level.
It's really interesting as it starts to drill down on the amounts of risk that a family and individual is comfortable taking here. I want to add another wrinkle to this too, because I think this is super important inside of this structure. Spend a minute on talking about Social Security, which is the other payment stream that often enters into this equation, often for people who are wondering about this component of how do I cover my essential expenses. Mm-hmm. When I turn on that Social Security, there's some important details on this. So why don't you talk about that for a second?
Yeah. Social Security is an annuity. It's protected lifetime income. And importantly, it's inflation adjusted. There's no commercial annuities that are truly CPI indexed. The CPIW, not CPIU, which is technical detail, but you get CPI adjustments for Social Security. Survivor benefits for the high earner and the spouse. Their benefit will last for the joint lifetime of the couple. Government backed as well in that regard. And there's delay credits. You could claim as early as 62. You can delay to as late as, well, you can delay as late as you want, but you'll get credits for delay through age 70. There's no reason to wait beyond that. And generally, at least for the high earner in a couple, if you're thinking about annuities, step one before any commercial annuity is to delay Social Security to age 70 for the high earner in the couple, because their benefit lasts for the joint lifetime of the couple. The delay factors for doing that really are not actuarially fair. They're much better than fair for consumers at this point. They were set in 1983 when interest rates were even higher than today and when people are not living as long. So the odds of benefiting by delaying Social Security are quite high. And that's the first step towards building more reliable income, at least after age 70. And it's okay to spend down assets more rapidly before 70 to get you to then having, at this point, 76 or 77% higher inflation-adjusted lifetime spending each year from Social Security for the rest of your subsequent life. Now, if that's really step one of the annuity conversation. Step two is if that's not yet enough reliable income, then also look at commercial annuities. But definitely don't overlook Social Security. And it would not be efficient to claim Social Security early and to then put more money into a commercial annuity product. The deal from Social Security is too great. It counteracts anything private insurers can provide.
It feels like people often will get hung up on, you've got a really great way of stepping back to see this very objectively feeling. I think people get hung up on the assets nobody feels like they know the money came out and went into the Social Security fund. They know their contribution over their working years, but there's that different attachment between I have money in this savings account, this brokerage account, or whatever else, and I'm purchasing the commercial annuity versus the money that they think in Social Security. It's just a hard conversation to have with an advisor. It's an essential conversation. I love that the way that you make this point.
Yeah, finding an annuity is tough because you see that big chunk of assets disappear from your balance. And so if Social Security didn't exist, you wouldn't have had payroll taxes taken out. You could have had more savings, but setting that issue aside, people love Social Security. And it's an annuity, just like a commercial annuity that provides a protected lifetime income stream. But it's a really important annuity because of that inflation protection and that survivor benefit that you don't see on the commercial side.
So before we get into some of the RISA framework stuff, which I really do want to go through with you, I want to go through one of the most common things we see in 401ks and retirement accounts is we see these equity glide paths. It's this idea that as we get closer to retirement or as we get into retirement, that we're reducing that equity allocation, we're reducing our exposure to the sequence of returns risk of a more volatile portfolio. And you've had some really interesting work around the benefits of a rising equity glide path. Can you just explain maybe what's going on there and why you dug into this as much as you have?
Yeah. And this is work I did with Michael Kitces, and it's, pre-retirement, no major conflict with what target date funds do, which are really popular now with retirement plans. It's when you're young, you have more human capital, your future earnings, that's usually more bond-like in nature. So you have a higher stock allocation when you're young. As you approach that retirement date, you've been converting your human capital into financial capital. So you lower your stock allocation because you have less bonds on the human capital side of the equation. So you have a lower stock allocation at retirement. Now, the issue is, what do you do post-retirement? I think for the most part, target date funds ignore retirement income. That's one of the big issues with the whole defined contribution pension world we've created with 401ks and so forth, is they're just accumulation based. The idea is you just flip a switch and take distributions post-retirement. But there wasn't any effort to think through the sequence of returns risk or the other issues we talked about. So the existing target date funds, they're either to retirement or through retirement. If they're to retirement, they just keep that fixed lower stock allocation throughout retirement. If they're through retirement, they usually continue to lower the stock allocation as you go through retirement. The idea of the rising equity glide path is, it's really, the starting point is like the 4% rule, which is more aggressive than target date funds are in that post-retirement period. And what we're saying is, rather than holding 50 to 75% stocks throughout retirement, you might start with a lower stock allocation at retirement, which most target date funds will be less than 50% stocks at the retirement target date. but then gradually work your way back up to that 50 to 75% stock range or whatever is, I mean, every case is different. The case we use in the paper was using 60-40 stocks and bonds through the whole retirement horizon versus starting retirement at 30% stocks and then working your way back up to 60% stocks. And what that does is it helps manage sequence of returns risk. You can really think about the market returns in retirement. Like there's 4 broad things that can happen. Markets can continue to go up and up and up throughout the whole retirement. And then whatever you do, it's going to work. You're not going to run out of money. That's a pretty good scenario. If you had a higher stock allocation, you leave a larger legacy at the end. But for risk management, the rise in equity glide path wouldn't hurt you. Markets could go up, earn early retirement, and then come back down in later retirement. It's the same sort of situation. If you get a good sequence of returns early on, sequence of returns risk works both ways. You're pretty much set for your retirement at that point. Then the next option would be just the actual historical worst case scenarios is markets go down in early retirement and then come back up. That's going to be the scenario where you get risk management from the rising equity glide path because you have a lower stock allocation early on when markets aren't doing well. You have a higher stock allocation later on when markets do well. And then to just complete the list, you could also have 30 years of market declines. There's no investing strategy that will help you there pretty much. So, and it's not historically you could see this happen, but it's hard to plan for that. So the realistic worst case scenario is markets go down early on, markets come up later on. The idea of increasing your stock allocation as you go through retirement helps manage that risk. And it doesn't hurt you from the ability to meet your spending goal if markets do better early on in retirement. And so it's really just mathematically pointing this out. Of course, there are behavioral issues like people's risk tolerance usually declines with age. And so if you're telling someone to be more conservative in their 60s and more aggressive in their 80s and 90s, that may not fly. So I get that. I don't really push this as a strategy people should use. Although I have heard from a lot of people over the years where this really resonates with them. And I think if it resonates with you, great. It's a really interesting type of strategy that manages risk in retirement. If it doesn't resonate with you, fine, don't use it. Obey your risk tolerance at the end of the day. But yeah, that's the basic story of the rising equity glide path.
One of the places this showed up for us a lot, and that we've referenced the work that you did on this, is especially when people aren't just using the money for consumption. So when they're looking at the gift to that next generation, or they're thinking about how this is going to go beyond lifetime, this is one of those encouraging data points that says, if you're past the point of covering the essential income from the asset liability matching, and now we're thinking about how do we invest this future asset for a future generation on a new time horizon, this rising equity glide path actually represents some of that bridge glue to like, yeah, you're 80, but look where you are now. Are we doing this for G2 or G3 or whatever it is? And how do we think about it?
Yeah, that makes perfect sense. It's at some point, if your plan is funded and you're not running out of money, you're kind of investing for the next generation. And so then you'd be using their time horizons and their risk capacity and their risk tolerance. And yeah, that usually the next generation can justify a more aggressive stock allocation than an 80-year-old retiree who's just investing for their own retirement at that point. So yeah, that's a great way to also frame a conversation around the rising equity glide path.
I want to talk about the retirement income style awareness framework, which I keep calling RISA. Is that wrong?
Did
I invent that? Okay.
That's how we pronounce it. I've heard many different pronunciations, but we say RISA. So thank you.
Okay, good. I want to make sure that wasn't just in my head. It's probably from one of your podcasts or something like that. So you and Alex Murgia came up with this thing. You put this together. I want to talk through what it is, kind of like the axes of it and how that works. And I just want to make sure I'm saying it out loud in case as we talk through it, if you want to interject at all. This tool, just like in what I just mentioned about the rising equity glide path, gets really, really interesting when we move past just like a couple and we start to think about complicated scenarios where it's more people on the team and the page and the financial plan who have different ways that they see the world. And it can be as simple as a husband and a wife or a spouses, but it can also be blown out in super cool ways. You invented one of the most useful frameworks that I've seen for thinking through this. So what is the retirement income style awareness framework? What's RISA? Let's start there.
Yeah. Well, it's kind of preliminary for that. It's kind of what we've been talking about the whole episode thus far. Like, I talk positively about annuities. Well, some people hate annuities. I can talk positively about investments. Well, some people are very scared of, like, even though the stock market should perform well, they just can't accept investing in the stock market. Well, at the end of the day, people are just wired differently for this. And so the RISA, the Retirement Income Style Awareness, was an effort to try to help people understand as a starting point how they're comfortable building a retirement strategy. I think there's a lot to be said for incorporating insurance like annuities as part of retirement planning, but I've also heard enough people complain about that I recognize not everyone, it's not right for everyone. There are different viable approaches out there, whether it is a more purely investment-based approach, whether it is an approach that will build a floor of protected lifetime income, whether it's a time segmentation or bucketing approach where you just invest differently based on the time horizons for those investments. How do you help people pick a strategy? And that's what the RISA was all about. Alex and I looked at everything we could find talking about retirement, identified where trade-offs were being discussed, started writing questions about how people might evaluate those trade-offs, and worked with a retirement researcher community, which is really a large kind of do-it-yourself online investing community at retirementresearcher.com. At one point we were looking at 900 questions, and they're very helpful in editing those questions and then taking different preliminary versions. And ultimately we got down to, at the end of the day, there's 2 primary factors and can be answered now with 12 questions. And it's just based on the statistical work. That's where I was saying I used to talk about probability-based versus safety first as schools of thought. Well, it's now just one of these factors. If you're probability-based, you're comfortable relying on the idea that the stock market will grow in a manner that you can rely upon to fund a higher level of spending in retirement. And there's no right answer here. If you're safety first, you may get the joke that, yeah, the stock market should do well, but you're fundamentally not comfortable relying on that when it comes to funding your essential spending in retirement. You'd rather have some sort of contractual protection behind that. The other, and that factor I could have guessed was going to be important. The other one that surprised me, but the data really just speaks to its importance, is this optionality versus commitment. If you're optionality oriented, you really value maximizing flexibility for all of your assets. It's like you don't want to lock in anything. You don't want to commit to anything. You just want to be able to make changes, respond to new situations. You really value optionality and flexibility. Some people are that way. Other people, though, have a commitment orientation. Now, the idea there is if you can find something that solves for your lifetime problem, you actually feel good about committing to it, taking it off your to-do list, even if it reduces some of your flexibility. We can also see there, people are worried about cognitive decline. And so they'd rather commit to something that will help them if they have trouble making financial decisions or that will help protect other family members. And so are you more commitment oriented or optionality oriented? And then the big aha was just based on those 2 factors, it explains all the different retirement approaches out there. And so that's the RISA matrix, the retirement income style awareness. If you're probability based and optionality oriented, that's a total return investing approach. Build a diversified portfolio and take a systematic distribution from it in retirement. If you're instead safety first and commitment oriented, that's really, before I start investing, I want to have a floor of protected lifetime income that may involve using a commercial annuity product. Then I have the foundation to invest on top of that for more discretionary goals. And those are the 2 core strategies that we see the most frequently. The other 2 are really behavioral strategies, and they evolve that way. So if you're safety first and optionality oriented, this is, I want contractual protections, but I also want flexibility and optionality. I think that describes the bucketing approaches out there, or also time segmentation. The idea that, well, I get my protections by having short-term buckets and fixed income. I get my optionality and flexibility with the long-term buckets focused on growth and investment assets. And then the other behavioral approaches, I'm probability-based, comfortable relying on the market, but I'm commitment-oriented. And also when you're commitment-oriented, you tend to also worry more about outliving your money. And so I think behaviorally, that's this whole conversation around something like a variable annuity with a lifetime income benefit. The story there is you can invest for growth, but if markets don't do well, you have a protected lifetime income stream. It's probably going to be less than with a fixed annuity, but nonetheless, you have a protected lifetime income stream. So you get your probability-based side, but you also get you're committing to something that will help you manage your longevity risk. And we call that risk grab. So everyone's going to have a retirement income style. And we really think that that's a great starting point for everyone as they transition towards retirement. You may not ultimately stick with the strategy that matches your style, or you may be income protection. But because of that, you have a job with a big pension. You don't need any annuities. You already have your income gap covered. So step one is just understanding your style. Then step two is working towards a financial plan and figuring out whether you need to take any action to help accommodate a strategy matching your style. But that's what the retirement income style awareness is really for me now. The step one of retirement planning, understand your retirement income style. And that helps cut through all this debate about the extreme. Sometimes you'll see news articles saying retirees should be 100% stocks. Well, that's going to be an extremist type probability-based approach. Or you hear the infomercial about how fixed index annuities solve every problem under the sun. Well, is that appropriate for you? It may be if you have more of an income protection approach. It may not be if you have more of a total return approach. And I think this can just help people cut through all the debate and get to a good starting point for their strategy.
I think it's so interesting because it acknowledges, and those examples you just gave are perfect for this. It acknowledges that a person can sort of have a hybrid approach within themselves of say, like, I need this up to this point, and then I don't need that beyond that. It can say I might have one spouse who understands the bucketing and time segmentation approach, and another one who's just like super, super conservative or super, super risk seeking.
Right. And there's 6 possible combinations of styles, but we see gender differences. And so the gender distinction is men do tend to tilt more towards total returns. Women do tend to tilt more towards income protection. And these are more common strategies in general. So the most common combination you'd see is the husband total return, the wife income protection. And that requires some conversations. And ultimately, income protection can be the compromise because it's not just insurance. It's first build a floor of protection and then you can invest. And so maybe a conversation around, let's take part of our bond allocation, put that into a protected lifetime income stream. Now the income protection person can sleep much better at night, knowing they have this reliable income source. And they can then permission the total return person, okay, you've protected me, go crazy with your investments at this point for the more discretionary side. So that can just be, income protection can serve as that sort of compromise when you have a total return and income protection person. And that's a starting point for, well, how do we figure out strategies to accommodate all the different combinations? Because most people don't marry based on having the same retirement income style. So you're going to see differences quite a bit.
You don't say. Inside of that, how have you guys talked as you're engaged in all these conversations about this, as you're engaged in the research on this? I mean, surely you found some interesting fringe cases here of some like funny combinations, and hopefully you don't get married for this, but hopefully you don't get divorced for this either. What are some of like the fringe combinations that lead to either unique or surprising solutions, if any come to mind?
Well, an interesting one would be the bucketing style or time segmentation along with income protection, where income protection is looking at more a floor for lifetime income, but bucketing likes having flexibility and so doesn't necessarily want to fully commit to a lifetime income floor. So they maybe a longer front end bond ladder, maybe even something like the QLAC, the Qualified Longevity Annuity contract that starts at income at age 85. So it's a lot less expensive to support that tail of longevity. That might be a way to accommodate the income protection person while still keeping more assets free. And then building a front end ladder too that can accommodate both for the at least having the upcoming expenses protected. But that's where the time segmentation wants more of that front end protection. The income protection person wants more of that back end protection. And so how can you figure out a way to provide both of those without necessarily providing a lifetime protection?
What about as we take this multi-generational? So you have parents and they figure out their situation, but then they have kids, and we've been running into this more and more just as, people's kids come into the equation, start to have the conversation, where sometimes you have parents who figure out what will work for them, but then there's clearly going to be an inheritance a generation or more forward, and they have their own risk profiles. They have to self-discover their own agency and figure out how to do this stuff too. How do you start to think about how these things stack cross-generation?
It's a good question. And partly so, I think the research we've done, you could take the RISA at 30 and it'll be accurate to explain your style. But then what does that mean? Like usually this is most relevant at that transition into retirement. I say I'm 5 to 10 years from retirement. Do I start adjusting my total return investment portfolio to accommodate retirement income? If I'm income protection, but I'm 30 years old, I'm not usually buying annuities at that point. I'm still going to have a diversified investment portfolio. So I think that could help it, like for the next generation that will receive that inheritance. They can figure out their retirement income style later on. For now, if they're younger, they need more of that diversified investment portfolio. And so that could be a way to think about it. It's not necessarily I'm going to go out and buy annuities for my 30-year-old children because they're income protection. Now, that's really too young to be thinking about those types of decisions.
It's interesting to think about how these things scale apart, especially when the assets that get left over, the intentionality around how those are constructed can make a really big difference. That's an interesting part of this, especially the more you get in beyond, I don't definitely need this for consumption. There's one thing to leave I don't want to call it the accidental gift, but it's the happy accidental gift of I didn't spend all the money and now somebody gets it, versus there's going to be more than we need. How do we actually make sure it's in the right condition for them to figure it out later?
Retirement styles could speak to that, but that may also just be different types of just making sure that children are part of the conversations, understanding their goals and needs, and working towards accommodating that.
So I asked this question semi-jokingly at the beginning, but I want to come back to this now. I said, if you went back in the DeLorean, you visited with Bengen, you got over his shoulder, you gave him some stuff to think about. How do you think this evolves going forward? I mean, we're 30 years off the 4% rule basically being invented or documented formally. What's the next round of research look like? Like, what else do we have to learn still about this that's not just whatever the heck sequence of returns are for the next 10, 20, 40 years?
Yeah, I think we're increasingly getting to the point where people are recognizing retirement income is different. And so you do the pushing the idea of retirement income styles, but you really do need to have an approach to accommodate that. You can't hate annuities and hope that everyone else hates them as well. They're going to be a good tool for certain members of the population. And so you really need to be flexible in how you accommodate different retirement approaches. They're all ultimately viable approaches. And I think we're really getting that kind of problem solved to some extent now there could be new designs for annuities, and we are seeing a lot of innovation in that area. But that's maybe just at the margin. How can we make things better? So my research in terms of what I'm working on besides that, I've focused more on like tax efficient retirement distributions and the question of should I do a Roth conversion and how should I draw from my taxable brokerage accounts versus my tax deferred IRAs versus my Roth IRAs. And I'm really seeing that can add a lot of value to the sustainability of retirement by being more efficient with taxes and boosting the after-tax rate of return on those assets. And Roth conversions are important. It's like so much of the research I do in one way or another points to make short-term sacrifice for long-term gains. And taxes is another example. It's like delay Social Security, short-term sacrifice for long-term gain. Income annuity, short-term sacrifice for a long-term gain. Do a Roth conversion, pay more taxes today to dramatically improve your tax situation in the future. Short-term sacrifice for a long-term gain. And it seems like retirement is so much about that. So maybe other research should just help understand who can make that sort of long-term focus and when not, how to accommodate strategies that might still work in the right direction without requiring too much short-term sacrifice.
It feels like too, if we fail to understand the logic and we fail to raise the questions about what happens when America gets rid of the defined benefit system aside from Social Security, what happens when we change these structures over time and different demographics boom and bust through just the ages of the people who are alive, and what happens if people just start living longer on average, which seems to be the skew that we're experiencing now. If more of us are around longer, we better understand these fundamental building blocks, the spreadsheets, the calculators required to say, what kind of new things, what new ideas or old ideas reimagined do we need to give people the outcomes we want, which is less people running out of money in older age. I think that's...
Yeah, it's different than in to some extent, retirement was a late 20th century phenomenon where you worked, then you might have 10 or 15 years in retirement and you probably had a pension to help cover that. Today, you're increasingly on your own with a defined contribution like 401k investment approach that you have to then self-manage in retirement. And your retirement could last 30 or 40 years. So it really is increasing the challenges that people face today as they make that transition towards retirement. Absolutely.
All right, I have one last question for you. I'm putting you on the spot with this. Are there any, what you would view as, or somebody else would call like excessive essential expenses in the Pfau household? Is there anything that you spend money on that you're like, no, it is essential, but maybe if the income got short, I would begrudgingly look at cutting it. Anything fun you're spending money on these days?
I've always been so frugal, and it's been more a matter of where I can, maybe I could spend a little more here or there. Some of those things I could cut. Take the avenue of, instead of getting a fancy car, you get a more basic car, but with a fancier trim. But maybe you don't really need the fancier trims. Maybe if you're going on a family trip, pick a less expensive Airbnb, something like that. But
well, what about the other direction? You just made it more interesting. If I give Wade Pfau the magic wand, what are you spending more money on to improve the essential qualities of life?
Oh, well, now my oldest has got 2 years left in high school, and so it's kind of the trade-off of I should probably be spending more today when the kids are at home and we have this family time instead of worrying about being able to spend in the future. So let's spend more now, and I'll build into my plan to spend less later on. But there's no reason to be more frugal now, because these are the peak years of having your kids at home and being able to do things with the family. And you kind of, when you have a kid in high school, you start to see, they're now already spending more time in their bedroom, not talking to you, and that sort of thing. So making sure this is the time we should really be spending, actually, rather than saving everything for some future retirement scenario.
It's human all the way down. We need all the math to help with these conversations, but it's just human all the way down. Thank you for sharing that. Wade, thank you so much for your time today. I really appreciate you coming on.
Absolutely. Thanks for having me on the show.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at @JJCarbono. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.